All right, welcome everyone to class 5 of the Master Trading course. All right, so today we're going to go over intraday chart patterns. So what have we learned so far? All right, we know the most important thing for successful trading is having a positive profit-loss ratio, a 2-to-1 profit-loss ratio with a 50% success target. All right, the proper stocks. So we're always looking for high relative volume stocks. Okay, and we talked a little bit on Thursday about what good daily charts look like. All right, now um, there's two parts to this next section. We're going to first talk about chart patterns, and then we're going to talk about the actual strategies. We've working always to develop this course and improve it. On the one hand, we have very clear chart patterns like bull flags and flat top breakouts, and then we have strategies for how we trade those patterns. So in this class tonight, we're going to talk just about looking at the patterns, identifying them, and learning the ins and outs of them. Okay, so this really comes down to how do we find entries, right? Because every time we take a trade, our whole goal is to have minimal risk with a good profit potential. So chart patterns are another way of us minimizing our risk as we trade. All right, so we know that the strongest stocks are going to form the best and the cleanest patterns. So the patterns that we're looking for, the chart patterns that are my favorites, are the flat top breakouts, the bull flags, the bear flags, and the flat bottom breakdowns. One of our biggest advantages, our competitive edge as day traders, is that we can see these patterns unfolding. High frequency traders, they're not able to see the patterns very well. Right? One of the things we've talked about is how difficult it is to scan for geometric patterns on charts. It's hard for the computer to recognize a pattern taking shape, right? And of course, depending on how you lay out your chart, um, you know, a pattern may look one way on one chart and it may look differently on another just due to your settings and your layout. So, the computer can't compensate for those changes, and as a result, the computers just aren't very good at identifying patterns unless they're super, super clear. So, our edge as retail traders is that we're able to identify these very strong patterns that are well respected by thousands and thousands of traders. Okay, so intraday versus daily charts. So we've talked about how a very strong stock on an intraday level can override a poor daily chart. So even though we were reviewing daily charts on Friday or Thursday, one of the things that I said is doing homework at the end of the day to try to find the best daily chart setups is not really something that I spend time doing or that I think is particularly important, because what I've found is that more often than not, a strong stock with a big catalyst can override a weak daily chart. Right? And on the flip side, a great daily chart usually can't override a poor intraday chart. A chart on the intraday level that has no volume, has bad spreads, and has no catalyst, even if the daily chart is terrific, there's just not enough people watching these stocks. So our whole approach is following the retail traders and following the volume around the market. So a strong stock with strong volume is going to do things that's, swing traders and traders that look at daily charts are going to think are irrational moves. But we have the volume, and so that's all it takes is big volume. So that's why we have to focus on stocks that are in play, right? The stocks that have that high relative volume. Now, with that said, some of the big trades, some of my biggest winning trades have been trades that had both the perfect intraday setup and a great daily chart setup, right? So that might be sort of the perfect storm combination, but I've had a lot of really great trades that didn't have good daily charts. So I just don't think it's required for day trading, right? So again, emphasizing that volume makes the pattern. Okay, so the pattern is forming. We have this geometric pattern, and that pattern is forming. But without volume, the pattern will not break out. Okay, so we're always looking for breakouts, not just the patterns to be, something that we can visualize, but we want to see the breakouts. So you always have to ask yourself, does this stock have high relative volume? And is there a spot where I think a lot of volume will come in? So a breakout spot. Okay? And when that volume comes in, what is it? It's confirmation. It's confirming that we're right, that the pattern that we saw unfolding is being recognized by other retail traders. Okay, so that's really important. When you see a breakout spot, an area where you think is the apex and no volume comes in, that usually tells you that you were mistaken in seeing that as the apex point because no one else saw it that way, right? There wasn't the volume, so you didn't get the confirmation. So always look for that confirmation. If you jump in something and you don't see the volume flowing, it's usually a good idea to get right back out. Just hanging out and waiting for the volume to come in, you're very vulnerable for a quick pullback because all the traders that got in early, however many there might be, eventually are going to bail out. So if you can get out sooner, your loss will be smaller. So for trend continuation setups, the breakouts are the best from 9:30 until noon, really. And 9:30 to 11:30 is strong, and 9:30 to 10 is really the strongest time of the day. Okay, so we look to get into a stock that's already trending. We must look for safe entries. Okay, so we can trade the pullbacks and the breakouts. So we want to set a tight stop because we're usually buying stocks that are somewhat extended. Okay, so as I said, cleanest breakouts from the open until lunch, and then from lunch on, it starts to get slow. And the afternoons typically are slow for pattern-based trading with the exception of reversals. And with the exception of applying some of these patterns to momentum stocks, stocks that have news in the middle of the day. Now, like I said before, we want that immediate resolution. So if we think something is going to squeeze at 5:15, when it hits 5:15 and it doesn't squeeze, we've got to get out. Immediate resolution or bail out. This for me is a risk management technique. So if I see that volume come in and it immediately pops to 525, that's great. I'm in the profit. And if it just hesitates there at 515, 516, that for me by itself, even though the price isn't dropping, the fact that it's not popping is a bearish indicator. So that's why I get out of these very quickly. And then my loss might be a couple cents, but it's not going to be all the way back down to 5, right? Why let it go that far against me? So for me, I've found the time that I can be the most aggressive and take really large positions, 5 to 10,000 share size positions, is in the first half hour of the day. Now, the last half hour of the day can also be strong for end of day runners. Okay, so a squeeze into the close, but that is not as common as the gap and go setup. So my squeeze into the close strategy, I will trade it from time to time, but the gap and go is much more consistent. Okay, so always focus on the first 30 minutes. Take what the market will give you by 10 a.m. All right, whatever that is. If it's $100, if it's $500, if it's a $70 loss, $200 loss, whatever the market's giving you by 10 a.m., take it. And then as a beginner trader, that's often a good time to switch to paper trade for the rest of the day. So take the money you can get by 10 a.m. and then go paper trading the rest of the day. Okay, so for these trending stocks, we always want to know that there's a catalyst, right? This means it's a stock in play. So the catalyst, like we've talked about, earnings, press releases, activist investors, FDA approval, some type of news that's really big for the particular stock or maybe the sector that we're looking at. Okay, that gives traders a reason to be excited. So we always want to be trading the stocks that everyone is talking about. Right? There's usually a handful of stocks each day that everyone's talking about, and those are the ones that we're going to be trading. Those are the ones that we're going to be looking for the patterns on. All right, so the flat top breakout pattern. This pattern is an ascending wedge. Okay, and we'll copy and paste this link. You can go directly to this link at daytradewarrior.com if you want to look at some examples of ascending wedges, and I'll show you some in a couple minutes here. So an ascending wedge, this is a stock that has recently popped up. That creates the flagpole, the pop up, and then the sideways consolidation. That's the flag pattern. So an ascending wedge is a type of flag, and it's consolidating under a flat top. So oftentimes we look for flat tops that are right at a whole dollar, say $50 or $50.50. Those whole dollars and half dollars are really good areas of consolidation, because when we get that pop over, we not only get a flat top breakout, we also get the breakout over a key level of resistance. So that's sort of two setups combined. Okay, so the coiling is good. When I say coiling, it's the stock consolidating under that critical level of resistance. The longer it consolidates there, the more it coils and builds up strength for the next move up. Okay, now we don't want to trade patterns that have a big U shape or a double top formation. So a stock that pops up to $50, pulls back to $49.50, and then comes all the way back up and creates a big U shape. That's going to be more of a double top, and double tops are a little bit riskier. What I'd prefer to see are stocks that come up, tap the level, and then consolidate sideways right underneath it. Okay, so for entry indicators, what I'm always looking at is the breakout over that critical level of resistance. Okay, so the resistance level, if it's $50, I'm going to want to buy right over $50 and set my stop at the low of the last 5-minute candle. So when I'm setting these stops, I always look at the low of the last 5-minute candle, because if we're making new highs and we're not making new lows, that tells me the pattern, the trend is intact. If we have a candle that starts to make a new low, that tells me the trend is starting to change. So as long as we're still making new highs on the 5-minute, or at least not making new lows, I'm willing to hold my position. Now there are times where the low of the last 5-minute candle is too far away, and in that instance, I may use an arbitrary stop like a 20-cent stop. Okay? So if we don't get that immediate breakout, and I'm say buying at $50, we don't get that immediate breakout, what I will often do is just go ahead and sell half and then wait for a moment, see if we get the volume, but because I've sold half, I've reduced my exposure a little bit. So if this does pull back, which is going to be my expectation if something is not popping, that it will pull back, I'm at least reducing my exposure. So the loss won't be as bad because I've scaled out. And then if it does go, then okay, that's great. It goes and I've still got half size. I'll do that on patterns that are strong, the stock is strong, but we don't get that immediate pop. So, I may not want to sell my full position because I still like the look of it. And so instead, I'll just sell half and just have my hand on the trigger ready to bail out. Okay, so, and again, the longer the coiling period, the better, right? When we have this long period of consolidation, we expect the breakout is going to be very powerful. So if we don't have that big spike in volume, that's really a problem. That tells us that people aren't watching this stock for a breakout. So flat top breakouts, these are consolidation patterns. We look at these up until noontime. In the afternoon, a lot of times this pattern, the flat top breakout, just doesn't have the strength unless it's a stock that had breaking news in the middle of the afternoon. Okay, so and we'll talk about the different strategies where we would use this pattern. So this pattern right here, it can be a sub-strategy of the momentum trading strategy, possibly the reversal strategy depending on how you use it, and definitely the gap and go strategy. So I'll use this pattern. I'll look for a flat top breakout on a gap and go strategy trade. I'll look for a flat top breakout on a momentum strategy trade. So we understand the pattern and how we trade the pattern, but it's going to change a little bit depending on which strategy we're trading it within. Okay, so your exit indicators for flat tops. Okay, so stop, like I said, is at the low of the last 5-minute candle. So if I'm risking 10 cents, my goal is going to be to make 20 cents using that 2-to-1 profit loss ratio. Okay, and once I can sell half at 20 cents, I'll adjust my stop to break even to protect profits. Now, oftentimes, even if I had a 20-cent stop, once I'm up 20 cents, 25 cents, I'm going to start scaling out a little bit, taking some profits because, being being up 5 or 10 cents, that isn't much, but being up 20, 30 cents, that's a more significant move, and that tells me that I did time my entry properly. So I do want to start paying myself when I'm up 20, 30 cents. Okay, and then we'll use a trailing stop to keep ourselves in the driver's seat and try to hold the stock as long as possible. Okay, and we'll go over the different trailing stops that I use a little bit more in our trade management class, but for now, just know that if I'm up, I like to lock in a little bit of profit and adjust my stop to break even. Okay, that's a way of managing risk, keeping myself in the routine of having lots of small winners, some small losers, but not having those big blowouts. And I hate going from up 20 or 30 cents, not only back to zero to actually a loss. That can be very frustrating. Okay, so this right here is an example of a flat top breakout. So this is a stock that popped up. You can see the yellow line, which is the resistance line at 470. We had consolidation, so we pop up, we pull back, we come up and tap it a second time. So that right there, that double tap, that's the double top. Okay, so we tap once, we come up a second time, and you see how we have a bit of a U shape here. So this pulled back a little bit. So buying on this double, that's a little bit risky. And what happens? That double pulls in. It doesn't break out, it pulls in. So if you did buy there, you would have gotten stopped out. Comes up for a third time, pulls in just slightly, goes for the fourth, and the fourth is the breakout. So I always wait for 4070 to print. I wait for it to actually break this resistance line before I buy. So that way I'm buying right here. I wouldn't have bought here because I didn't have the break. I wouldn't have bought here because I didn't have the break. But I do buy it here. And you know what sometimes happens? We get a candle wick and then it comes back in and I bail out. Right? But other times we get this nice move here up to 5 looks like 505 or 510. Okay, so a very nice clean move up. And this is using the 5-minute chart. Okay, now this flat top breakout happened to have a good trigger on the daily chart, but notice what time of day it was. Okay, a big spike up in the morning. So this would be a gap and go strategy. We probably would have traded this for a gap and go, and then it stays in stock. This stock stays in play as a momentum stock. Okay, so then we get that sideways consolidation, and then the pop up here around 11:15, 11:30. We peak up at 12 noon and then sort of sideways during the lunch hour, and I don't know where it went from there. Okay, so that's a really nice flat top breakout. So that's a pattern that we're looking for, that ascending wedge. So the bottom of the wedge is the support line coming up, an ascending support line, and this flat top, that forms the top of the wedge. Okay? So here's a flat top breakout. This is a symmetrical wedge. Okay, so instead of being a flat top up here, we don't actually have any flat top. It's just descending resistance and ascending support. And the apex point is right here where those two lines cross. Now in this case, the stock started breaking to the upside just before the apex point. And you could buy it down here. But do you see volume coming in right there? Well, maybe a little bit. There is a little bit of buying volume here. Some of the smart traders are coming in early. But the majority of the volume comes in right here at the high of day spike. Okay, that's the big volume that comes in right there as we spike to new highs. The problem is that we have a bit of a U shape here, where this popped up, pulled back, popped up to 37.70, pulled back, pulled way back down to 36, and then came back up here. So there's a lot of negative space, and that means there's more risk. That means our stop is further away. And in this case, we broke 37.70, we popped up, we squeezed up, looks like to 39, almost to $40, which is a big squeeze, but we weren't able to hold and we pulled back. So this is a good example of why it's good to take profits into these squeezes so you don't let this winner turn into a loser because you sold down here on the bottom of this candle wick. All right, so whenever we get into a trade that spikes up like this and then sells off, I take the profit, adjust my stop to break even, and in this case, I would have gotten stopped out. Now, it bounced off the lows and then popped back up and made another move. We could have gotten in this for a second trade. In this particular case, the second trade probably would have been a break to new highs. It spiked up to new highs, pulled back. Maybe would have been a small winner or a small loss, depending on where you stopped out. And then when it broke the high of that candle, that's when it really took off. Okay, so you can see when you have tight consolidation along the highs, your breakouts are stronger. When you have a looser consolidation here, your breakouts are going to be weaker and choppier because you have people that bought down here that are going to sell into this move, and you have short sellers that are going to come in here and short this spike because it is overextended. All right, so this is a symmetrical wedge, and then it forms a little bit of a double top here, consolidates, and then makes another breakout there. CYTK, consolidation on this one, 776. So this is a nice one. We get that nice quick gap and go, right? We pull back and then surge up. Really nice move. A little bit of consolidation here, a breakout, more consolidation here, a little bit of pullback, and then we come back up, and when we break that level, we pop. And look at the volume. See, we have that big volume bar right at the same spot. Volume at the breakout. So that's the confirmation that other people are watching these levels. This stock also happened to have a very strong daily chart. There was no resistance nearby. But this wasn't going because I had a strong daily chart. It was going because I had a news catalyst. Here's another example, NDRM. Okay, the stock pops up here, midday consolidation. This is a little bit of an unusual time of day to have this type of consolidation, but we consolidate here right under $12. $11.97 was the high. We tap it, we pull back a little bit, we come back up, and we break it. The volume comes in, the break of 12, and we go from 12 to $14. Big spike up. Now traders that miss that move see this consolidation, they buy the pullback, and look at the big volume that comes in as we break. Now in this case, again, we've got a little bit of a U shape. So here we could choose to either buy the high, which is 14.12, or take a starter on the pullback with a stop at the lows. Okay, so we could have a stop at the low of the pullback and start taking a position here. If this is a strong stock, this was a strong stock with news out. You can see the type of day it had, from $8 up to $18. Okay, so really big move for this stock. So when we see consolidation on a very strong stock, it's safer to think that this could be this pullback could be bought up. Okay, so in this case, it's okay to sometimes take a little bit of a position here early. Early means you don't have confirmation, but if you can get a tight stop here, then your risk-reward ratio is going to be really good. Okay, so that's why I'd consider it. Spike up to 14.12, through 14.12, a little bit of a pullback, and then it goes again up to 16.72. Okay, so that was a really nice one. Here's another flat top breakout, MOC, 339. We pop up, we pull back, we pop back up, consolidate over 340. That was the spot, and this spiked up to, I believe it was 375. Okay, so you can see this is a very clean pattern again. Big spike up, sideways consolidation. The easy spot to buy would be down here on the bottom, which is why buying here at 339 is buying the double top. Buying the double top is risky. Wait for it to pull back. Now it's a triple top, so now we've got a flat top, a very clear line in the sand over 339. That's a spot where a lot of buying volume is going to come in. When it breaks that, off to the races. Okay, here's a flat top breakout on NLNK. So we've got our consolidation here right under $30. So we can see this was a stock that had made a nice move up, had a nice daily chart, a clean daily chart. We get that consolidation here right under $30. So we have two setups. One, we have consolidation under a critical level of resistance, the double zero, right? $30, so the whole dollar. And we have a flat top ascending wedge. When we get the breakout, we have two things happening. Anyone that's short, the logical place to put stops is right around the whole dollar because that's an area of resistance. Once we break over that, A lot of times it's just good to bail out, cover your short position, so you have shorts that are going to cover, and you're going to have longs that are going to jump in here for the breakout. And look at this breakout from $30 up to 32.66, 65. Look at that move. I mean, that's huge. Over 2.5 points. That's a beautiful flat top breakout. And here we had really nice consolidation. In this case, there really wasn't a good opportunity to buy on a pullback. You had a teeny U shape right here. Okay, and these are also called cups. You had a teeny cup formation here, but not very much of one. So it's not like anyone that bought here, you're not going to have to worry about people selling into you because this was the clear spot to buy. So this is an example of a very tight coiling pattern. So the tighter the consolidation, the better. The stronger the breakout when they go. Okay, now flat bottom breakdowns, same thing, they're just reverse. Okay, so it's the exact same setup, it's just in reverse. Okay, now I am more biased to the long side. I find the flat top breakout to be a much more successful pattern than the flat bottom breakdown. So I'm not going to spend any time focusing on the flat bottom breakdown other than to show you this one example here of the consolidation at the lows and then the sell-off. It's just the reverse of the flat top breakout. If you like to short stocks, then you can apply that pattern to this short side type of setup. Okay, and you can check out this link if you want to look at some more. So the bull flag pattern. Okay, so this is the second pattern we're going to talk about. Bull flags, they're a little bit riskier than flat tops, but a lot of times they work really well, especially on high volume stocks, either in the morning or midday when we have news. Okay, so we'll look at a picture of the bull flag in a minute, but the bull flag, essentially, it's a stock that quickly moves up and then pulls back for usually 1, 2, 3 candles before making another big move up. Okay, so whenever we see that pattern, we know we're looking at a bull flag. So a bull flag, essentially, we are considering buying what you might look at as a double top, but we hope that the pullback isn't so much that there's a big cup or U shape formed. Okay, so with a bull flag, we really just want to see a quick spike up and then 3 candles that are almost just sideways rather than really pulling way back, and then buy as soon as we start to get that volume coming back in. Quick ramp up, small pullback, and then go. Okay, so one of the ways I find the stocks that are forming bull flags is just by watching my surging up momentum strategy scanner window on Trade Ideas, right? Because that tells me where there's the most volume right now in the market at any given time of the day. So any stock that's experiencing a ton of volume, it's going to be on the surging up scanner. I can look for bull flags forming on those stocks. Okay, so bull flag patterns. When we're looking for the entry, we want to see that sharp ramp up and a very small pullback. So the pullback, generally, I don't want to see more than 30% of the move up, and it has to hold the 50% retracement line. So if something spikes up $1, pulls back to 70 cents, that's fine, that's good. Pulls back to 50 cents, well, I don't really like that so much. Breaks 50 cents, it's no good. It's broken its pattern. All right, so depending on the strength of the volume and the time of day, you can apply the bull flags to either 1 minute or 5 minute charts. So on a 1 minute chart, if you have 3 or 4 candles that spiked up because we have breaking news in the middle of the day, we look for the pullback, and then the first 1 minute candle to make a new high, we can jump into that, buy it, and look for that breakout. Okay, now if there's not enough volume on the 1 minute, then we might look for bull flags on the 5 minute, and that works too. Okay, it just depends how much volume there is, really, and how strong the catalyst is. Now, your stop on a bull flag is always going to be at the low of the pullback. So in that example, we have something that spikes up $1, pulls back 50 cents, and then starts moving back up. Your stop's at 49 cents, 50 cents, right at the low of the pullback. All right, so when do you get out of a bull flag? What's your exit indicator? So like the flat top exit indicators, I set my stop at the low of the last 5 minute candle if I'm using a 5 minute chart, or the 1 minute candle if I'm using a 1 minute chart. Okay, so once I've started to hit my profit loss ratio, 2 to 1, even if I just have 1 to 1, but I'm up 30 cents, I'll start locking a little bit of profit and adjust my stop to break even. Okay, so the time to get out of a bull flag is the first candle to make a new low, either in the profit zone or if it's at a loss, you're at a loss. Either way, as soon as you have a candle making a new low, time to get out. Okay, so here's VA, buying the first pullback on the gap or momentum stock. A big spike up here to 37.50, a little bit of a pullback. We didn't pull back as far as $37, so a nice move up, slight retracement, and then we go, right? So buying right here on this green candle, the first candle to make a new high. And the big volume comes in at the high of day, but in the bull flag, we're in a little bit earlier, which is why bull flags are a little bit riskier than flat top breakouts. But, with that risk comes the reward that we're in this a little bit earlier and we're going to have a better average. Okay, so over 37.50, it pops up to 38. Sideways, we sell. First 1 minute, first candle on the 1 minute to make a new low is this red candle, and you bail out right there. You don't have to wait for it to hit, the low of that candle period. As soon as it makes a new low, you can get out. Okay, this is Zaza. Very nice flag pattern. Again, a surging up momentum stock. So this was on our scanners. Stock surges up. A little bit of sideways consolidation. Now, like I said, I usually like to see 3 candles of pullback and then go. This had 1, 2, 3, 4, 5. That's a little more than we typically like, but we're still going to look for the first candle to make a new high. This green candle made a new high, pulled in. It didn't make a new low, and then it goes. All right, so this would have been a little bit of a kind of nerve-wracking moment here because you get in here and you're not quite sure. Made a new high and then it pulled right back in. Is this a fake out? And then it goes on the next candle. Okay, and now notice the volume pattern on the bull flag. Volume pattern on the bull flag is important. You're going to have strong volume. You want heavy volume on the ramp up here, super heavy volume, and then you want light volume during the pullback. So this tells you rather than shorts coming in and just slamming this thing, it's really just people, a few people are selling their shares, getting out, whatever, but it's more just digesting or consolidating rather than experiencing a huge sell-off. Okay, and now when we're looking at stocks to reverse, when we're looking at the bottom bounces, we look for stock, or in this case, say we wanted to short this, we want to see a stock that has tons of volume on the ramp up and peaks out at the top, and then there's volume selling off too. Okay, high volume on the ramp up, but then no volume on the sell off, that tells you that it's probably going to make another move up. In this case, I had to pull back a little bit before it was ready, but it did end up making a nice move back up. Okay, so this is a bull flag. So here's another flag. On this one, we've got the good daily chart. This is just a little bit of consolidation here, right under $17. So we make a move up, a little bit of consolidation. In this case, the consolidation is basically just sideways. We don't even really pull back. And then we break over that whole dollar. Look at that pop, all the way to 17.54. A little higher, it looks like. So a nice 50-cent move right off that little flag. So flags are going to come in different shapes and forms. This one happens to be very tight and almost no pullback. So it's almost a flat top, but it hasn't tapped enough times to be considered a flat top. All right, another bull flag here, a little pop up, couple candles of pullback, and then it goes. Couple candles of pullback, and then it goes. All right, so on these pullbacks, pullback to the 9 moving average, stop is at the low of the pullback, and then you go. Right? Pullbacks to the moving average, stop is right here, and then you go. You always have your stop right down here. So some of these aren't going to break out. They're just going to come and test it and then make a new low. But this is a pattern that works really well. But what time of day does it work best at? 9:30 to 10:30 in the morning, sometimes until 11:30 or noontime if the stock is strong. Okay, so this works best in the morning, and it works really well if this stock, even if this is 3 in the afternoon, if it just had breaking news. trying to apply this pattern to a stock at, noontime or 1 in the afternoon that doesn't have high relative volume, you're usually going to take a loss on it. Okay, here's another one. Quick pop up, couple candles of consolidation, a little bit of pullback, and then another move back up. Okay, so this is the pattern that I'm using almost every single day. These are the patterns that I'm looking at when I'm trading my gap and go strategy. So like any trading strategy, the strategy includes specifically what type of stocks I'm going to trade, what time of day, what my average profit loss is, what my percentage of success is. The strategy has a lot more information. But in that strategy, I trade this. This is one of the patterns that I'll trade, the bull flag. Okay. Here's another bull flag. Pop. Oops. What did I do? Okay, here's another bull flag. Pop up. A little bit of pullback, and then another move. This one ended up being a fairly small move here. Pops up to, let's see, 71 something. Pulls back, pops up, and then it can't hold that level. That's why it's good to take a little profit into the move, because when you hold these and they start turning against you, they can make really a quick pullback, and that's not something you want to be holding through. And this one's actually pretty frustrating because you can see it popped up, pulled back, and then it rips. So, why some stocks do this, it looks like this particular one, news came out here at 11, probably 11:15, there was breaking news. So this stock was of no interest, then all of a sudden news comes out. And when news comes out, these stocks can be pretty volatile, right? You can have these quick spike up, spike down, choppiness, and then they start to choose a direction. All right, so bear flags, like the flat bottom breakdowns, not a strategy that I trade very much, okay? But in general, they're the reverse of the bull flag. It's a quick drop down, a couple candles of bouncing, and then more sell-off. And any pause in the selling is considered bearish. Okay, so weakness in these trades a lot of times can just result in sort of day-long grind to the downside. All right, so if you like trading to the short side and you're good at recognizing these patterns, you can apply the bear flag to weak stocks that are at lows. In most cases, anything that I'm looking at for a bull flag is going to be at high of day. Anything I'm looking at for a bear flag is going to be at low of day. Same thing with the flat tops. Flat tops are consolidating at high of day, flat bottoms at low of day. Okay, moving average pullback. So moving average pullback, essentially a longer flag formation. So many stocks, they're going to trend up, pull back to moving averages, make another move up, pull back to the moving average, another move up. So these pullbacks can be buying opportunities, right? If the moving average holds. So we have to see which moving average is in play, whether it's the 5, the 9, the 20, the 50. There's often a moving average for a stock, whatever stock it is. It's going to choose a moving average, and that's going to be the one that's well respected throughout the day. So the smart buyers are going to look to buy that first pullback, that first bounce off the moving average. So there are traders that just wait for the bounces off the moving averages. Now, for me, I focus more on that moving average being part of the context of a bull flag or a flat top breakout rather than just buying it as a pullback. I make sure it's part of a bigger pattern. But if you like buying pullbacks, if you are familiar with this pattern, it can work really well. So here's a stock that pops up, pulls back to the moving average, taps it, and then makes another move up. Okay, pulls back almost to the moving average here, makes another move up. Now the thing is, this moving average is the one that's being respected. It's worth watching throughout the day. But I would be looking at this also as a bull flag, right? The pop, a couple candles of consolidation, recognizing that we have the pullback here to the moving average. This again helps me see the context that, okay, this is a strong stock, consolidation is here, we should find support here, this should be a good bounce spot. Okay. So now with news and IPOs, this is an important area to discuss because these stocks can be extremely volatile and very, very risky. Even when we have bull flags and flat top breakouts, these can still be very choppy, and what we think is going to be a very clean breakout a lot of times is not. So just remember that news is risky. You can easily be down several points trading news. We had a stock today that dropped 15 points and then bounced back up. So from $195, it dropped down to 180 and then made its way back up to 195. Okay, that kind of volatility from news. Imagine if you shorted it at $180. That could bounce 10 points against you, right? So we look for volatility, but we want to trade volatility in a way that's relatively predictable, right? We're trying to manage our risk as best as we can. So if we're trading news and we don't understand the news, it can be very risky. And the thing is, even if you think you understand the news, you may have a good understanding of, that business or the sector, but the reality is news that you expect to be interpreted one way could end up being interpreted a completely different way, right? And that's one of the most frustrating things with trading fundamentals is something that you think is, a fundamental sign of weakness, the market's going to react strongly, right? The stock runs. It doesn't make sense, but that's what sometimes happens. So news, you just have to be very careful. I do trade news from time to time. I do trade IPOs from time to time, but they're risky and you just have to take it easy. Okay. The big thing that I look for when I'm trading news is lots of volume. So I want to see the volume coming in and sustaining. All right. So first candle, 200,000 shares. Second candle, 20,000 shares. That's not good. All right. We want to see sustained heavy volume. That's really important. So an example of a news trade, this stock, there was some Carl Icahn activist investor speculation in Walgreens. Let's see, where was this? I'm not sure what the date was, but this pops from $62.50 up to $65. That's a big move. Okay, now should be familiar with Carl Icahn, maybe familiar with some of the other activist investors. We know that when they get in stocks, lots of people are watching them. So, there are certain types of news that we just know that's a big deal, and this is one of them. In this particular case, you can see this is a 1-minute chart. The 1-minute chart didn't even pull back. It just started ripping. So, when I hear Carl Icahn's in something, a lot of times I'll just take a stab at it, but I'm not going to go in with my full-size position because I know when you go in with full-size position, you need 100% confidence, right? If you're putting your full-size position into a stock, as soon as you get in, you've got to have total confidence. So with a news trade, it's hard to have total confidence. Even if the news sounds amazing, it's still hard to have total confidence. So with these, you just have to go in a little lighter because sometimes you're going to take a news trade and you're going to get destroyed, especially if you take size. You could take 200 shares and lose a point. And you're just like, wow, that was so fast. I'm glad I only took 200 instead of 2,000, right? Because that's how quickly they can go against you. Okay, another example of a news trade. This was Gilead. And this is a good example of a news trade also having a tradable pattern. So this is where we can get into developing a strategy of trading news, where the strategy might be, well, we trade, pharmaceutical stocks that have breaking news midday, FDA approval, stuff like that. What patterns do we trade in this news-based strategy? We buy the first pullback. Okay, so if you buy the first pullback, or say I buy the first 1-minute candle to make a new high, you're a buyer at 96.80. Okay, 96.80, and it spikes up to 98.70, a little choppy along the way, but a fairly clean move. Okay, so we got in this, sold a little up here, it pulled back. Can't remember exactly where I got out of it, but overall it was a good trade, and the setup was buying the first 1-minute candle to make a new high. This was a small, tight flag. Okay, pop up, a couple candles of consolidation, and then we make another move up. Now, this is an IPO example, which this was an IPO that was halted, I guess, 2 times. It was halted right in here, reopened, surged up, halted again, reopened, surged up. So it was halted once, twice, 3 times, and then it dropped down, was halted a fourth time, and then it was sideways. That's how risky these can be, from $18 up to $30. And this is only in a matter of about 20 minutes. Okay, so IPOs, news, very risky. Can we get home runs? We can, but rarely are we going to be able to go in with the amount of size that we would need to really get a home run winner. I mean, we could get a home run percentage gain on 200 shares, but are we going to get a home run winner, in terms of a $5,000 or $6,000 profit? Not usually, unless you're taking massive size. And if you're taking really big size, you're kind of gambling, right? Because there's a high risk that some of these trades are going to go way, way, way against you. So that's the risk. All right, so when we're looking at intraday chart patterns, right, we're focusing on chart patterns as another measure to reduce our risk in the market. Okay, so all the steps we've taken at this point, from learning risk management principles of the 2-to-1 profit loss ratio, of the percentage of success we need in order to survive in the market, all right, to choosing the right stocks, which types of stocks does this strategy work on and which stocks does it not work on, okay, to daily chart setups, okay, and now to intraday chart patterns. All of these are steps to managing risk. What we do every single day is sit here and manage risk. That's what makes us successful traders. That is ultimately what will make you a successful trader, is if you're able to manage risk properly. Okay? Like I've said before, choosing the right stocks, it's important, but it's not as important as learning to manage your risk on every single trade. So by only taking strong chart patterns, you're again reducing your risk as a trader, right? We know these chart patterns have a certain percentage of success. If we're taking patterns that are anything less than a perfect pattern, our odds of success are going to decrease exponentially, right? As the pattern gets weaker and weaker, our odds of success are going to drop quickly. So we only want to take strong setups. So when you sit down in the morning, you have to say to yourself, I'm only going to take strong setups. And if there aren't any strong setups today, I'm not going to trade, right? This might be a day where I don't get in any trades. You have to remember, every single day you're in the market, you're learning. Once you develop one strategy that you can trade, you're going to be able to survive in the market. You're going to be able to tread water, right? Treading water is better than drowning, okay? So even if you're not, an Olympic swimmer in this kind of comparison, as long as you're treading water, you're doing well, you're surviving, you have the opportunity to continue to learn as a trader, okay? So honestly, trading, survive until you learn. I've heard so many traders say that. The longer you're in the market, the more you learn. I still learn every single day that I'm trading. This is a job where you'll never get to the point where you've maxed out on your learning. That's just not going to happen. There's always going to be room to continue learning. So, the trader that you'll be in 6 months is going to know more about the market, and it's going to be able to make better decisions than you right now today. So if you're thinking about taking 5 and 10,000 share monster position sizes, hold off on those until you've got a little more experience and a little more confidence, right? Let the you in 6 months handle those big position sizes. Trying to do that right now might be too soon, especially if you're a new trader and still developing consistency. Okay, so anyone that has questions watching the recording, feel free to shoot me an email, ross@daytradewarrior.com, and anyone in class right now that has questions, feel free to call them out.